In the history of global industry, periods of dramatic technological disruption rarely lead to stable hierarchies. Instead, they produce cycles of competition, consolidation, and crisis. Tesla Inc. once embodied the disruptive force, pioneering the electric vehicle market and achieving a valuation previously reserved for technology giants. But the rules that govern the automobile sector, reliability, volume, and predictable profit, eventually assert themselves. The system Tesla built was predicated on two pillars: the continuous expansion of mass-market vehicle volume and the strict framework of corporate fiduciary duty established by the Delaware Court of Chancery. This stability was maintained by the rapid success of the Model 3 and Model Y, which established the company as a manufacturing force, not just a promise. For years, Tesla traded not on traditional automotive metrics, but on the narrative of perpetual growth and technological supremacy. Its stock multiple, reaching nearly 100 times estimated earnings, reflected the future potential of self-driving software and robotics. But this extreme valuation made the entire structure profoundly fragile. It rested on the assumption that the company could deliver on both high-volume affordability and revolutionary autonomy simultaneously.
By 2024, the structural pressure became undeniable. The product lineup was aging. The promised low-cost vehicle, often called the Model 2, had yet to materialize. Meanwhile, formidable international rivals, particularly BYD, mastered high-volume, low-cost production. They were gaining traction worldwide. In key global markets, Tesla's dominance softened sharply. July 2024 data confirmed a global trend. Sales in the UK dropped nearly 60% year-over-year. In Germany, sales fell by 55%. Even in California, Tesla's most loyal region, deliveries declined for the 7th consecutive quarter. This decay was structural, born of stalled innovation and fierce competition, not short-term market fluctuation. The company was no longer insulated by novelty. Its valuation, supported by future claims, began to feel the friction of current reality. The financial vulnerability exposed a critical flaw in the system: a board of directors highly susceptible to the demands of its CEO, Elon Musk, whose personal financial and strategic interests were increasingly diverging from the core automotive business.
The immediate consequence of the crisis was the complete breakdown of traditional corporate governance. In July 2024, despite the dramatic sales collapse and strategic instability, Tesla's board approved a new, interim compensation package for Musk, valued at approximately $29 billion. This award was a tactical move, designed to satisfy the CEO's demand for greater equity. Critically, unlike the voided package, this new award had no operational or financial performance metrics attached. The sole condition was Musk remaining in a senior leadership role for 2 years. Critics labeled it a blatant act of rent extraction, demonstrating a board more dedicated to humoring the CEO's whims than upholding fiduciary duty to shareholders. The ultimate confrontation, however, was jurisdictional. Having been judged harshly under the shareholder-friendly laws of Delaware, the company's leadership orchestrated the reincorporation of Tesla from Delaware to Texas. This strategic flight was a clear maneuver to seek a more permissive legal environment, attempting to shield corporate decisions from the stringent oversight of the Delaware Chancery Court.
This phase closed not with stability, but with transition. The immediate crisis of the $56 billion package was managed through the replacement $29 billion award and the legal migration to Texas. However, the foundational governance issues remained unresolved. The company's focus is now entirely reliant on a technological breakthrough that is not yet viable, while its core automotive business hemorrhages market share. The strategic tension is stark. Tesla currently trades at a price justified by the distant promise of autonomous robo-taxis, yet its survival depends on the aging Model Y and Model 3 remaining competitive against rapidly advancing rivals. Success in this new configuration is not guaranteed. The $29 billion grant increased Musk's stake,
but still left him short of his stated 25% control requirement, setting the stage for future compensation demands or further resource diversion. The system adapted to disorder not by strengthening accountability, but by allowing power to consolidate. The pattern repeats. The narrative, once again, overrides the fundamentals. The fate of Tesla and the integrity of corporate governance now rest on the commercial viability of a car without a driver and a board without clear limits.